The 21st century will be the end of the American empire, which means it will be the end of dollar domination. So what comes afterward is the question. Well, first we have to talk about what is here. And what is here and what is happening in the here and now is that the United States is doing everything it can to plummet Europe into an economic crisis and collapse, using the Ukraine crisis as an excuse. And this has been an objective since day one for the United States. It is an objective that the United States has had for quite some time now, where Russia and China and Europe have all become much more integrated than ever before. And the United States has wanted to undo that. The United States has also wanted to undo any possibility that European countries can come together and form an economic unit stronger than the United States with more influence. So it's done everything it can to make the EU into a vassal apparatus and has succeeded largely. And it's not a new phenomenon. Certainly, this has been happening over years and years and years. But now we're seeing, in a moment of crisis, in a moment where you have this earth-shattering conflict between Russia, Ukraine, where you have consequences that are so far-reaching, and you have the European Union bowing down to the United States at every turn, saying, yes, we will do whatever you want when it comes to Russia, economic warfare, whatever it is, we'll do it. And now we're seeing the consequences of what happens when a country is when the region, but the countries of Europe, the old empires, when they make themselves vassals of what is a collapsing empire. They're making themselves vassals of a collapsing empire. So here you go. I'm going to do an RT article, and maybe I will also review a Financial Times article if we have time, just to get the differing perspective. So here's what RT has to say. The dollar is stronger than the euro for the first time in 20 years. This was today. The U.S. currency traded above the euro on the Russian exchange. The euro fell below the U.S. dollar on the Moscow exchange on Tuesday amid fears that the energy crisis will tip the European Union into recession. The dollar-ruble rate stood at 58.70, while the euro decreased to 58.52 against the ruble as of 10:56 gram GMT. So that's incredible. And one of the ways that's incredible is not only because the euro has fallen, but what's happened to Russia. This is a really important point, because the whole idea of this economic warfare was not, I repeat, it was not to necessarily create a situation where Europe is the principal loser. No, Europe is a loser as collateral damage. That's what the United States wanted. The United States wanted all the cake, right? That you have your cake, eat it too. It wanted all of it. It wanted Russia to suffer, and it wanted Europe to suffer. It did not, I don't think, calculate for just Europe to suffer. But that's what's happening. So on the Moscow exchange, the euro is actually below the dollar. And that's because the ruble has not fallen in the ways that the United States hoped it would and that Europe hoped it would. Actually, the ruble has done better because Russia has paid specific attention to how to respond to the monetary crisis, the asset crisis, and the economic crisis that the United States was trying to impose onto Russia. So Russia has responded. Russia has used its resources, has sort of used its ability to navigate and reorient its economy so that the ruble remains stable. And with that stability has come the ruble doing better and better and better when pegged against the dollar or the euro. And that's what we're seeing here. So on the international exchanges, the euro edged closer to parity with the dollar. In a choppy forex trading, the European currency slid to just 1.0001 to the dollar, its lowest level in 20 years, meaning if you're paying euros, you're exchanging euros, right? Maybe you're at the airport, maybe you're at a bank. You say, hey, I've got 50 euros. Give me dollars. Well, you're going to get $50 in less than what? Less than a cent back, a fraction of a penny. The euro has fallen 12% against the greenback so far this year as a surge in energy prices in light of the conflict of Ukraine and sanctions against Russia, the continent's main energy supplier, has hurt European economies. For the first time in 20 years, parity has formed between the euro and the dollar as the U.S. currency continues to rise in anticipation of the tight monetary policy of the Federal Reserve. Yegor Zilnikov, chief analyst of the Economic Industry Analysis Department of Proms Weisbank told RBC Daily. We believe that until the ECB meeting on July 21st, the dynamics may continue and the dollar will become more expensive than the European currency, he explained. The growing anxiety over Russian gas supply has added to the pressure on the single currency. On Monday, Gazprom turned off the Nord Stream 1 pipeline that carries gas to the continent for annual summer maintenance. The repairs, which will last until July 21st, has been previously scheduled and agreed with all partners, according to the operator. Fears are rising that Russia may not switch the gas supply back on in 10 days when the works are over. Fiona Sincata, senior financial markets analyst at City Index, told The Guardian, this could cause a recession in Europe, she warned. So who holds the cards here, guys? Who won the war? It's obvious that Russia is not losing here, that Russia actually has a lot of leverage, and it is using it as it should. I mean, Russia has been put into a corner. If you didn't believe Russia was in a corner when it announced its special military operation in late February, it's in a corner now, economically. All these sanctions. I mean, imagine Europe and the United States form what? A large section of the world economy as a whole. We're talking about upwards of 30, 40, 50% of the entire world economy. And you try to isolate it completely, Russia, completely from it. What do you think Russia's going to do? What it has to do. And that's what's happening. And it's blowing back hard on Europe, especially. And that's what the United States likes to see. They like to see this. And so actually, my wife has a friend visiting right now who lives in France, and she's not aware of this. But I was talking to her about, hey, brace yourself for the recession to come because it's coming, because that's what everyone is talking about. And it's going to hit Europe first because of the ways in which Europe and Russia are so integrated in terms of their energy supply system. And the United States is going to do everything it can to artificially stabilize, meaning just kind of pull the veil and wool over our eyes as an economic crisis happens, but we can expect that Europe will feel it first. And that's what all signs are pointing to. So I'm going to pull up actually a Financial Times article to see what they have to say about this as well. I like to read the Financial Times. Is this the right article? Oil? No, this might not be the right article. Sometimes it does this. There we go. Jeez. Sometimes Financial Times like goes to a different article when you click on the link in Google. It's weird. So here we go. It says euro approaches dollar parity and government bonds rally. Oil slides below $100 per day, $100 a barrel on recession fears. So continuing fears about the coming recession on Tuesday pushed oil prices lower, the euro towards parity with the US dollar, and government bonds higher. International oil benchmark Brent crude, which had climbed to almost $140 a barrel in early March as Western governments repaired sanctions against big producer Russia after its invasion of Ukraine, fell 7.1%, settling at $99.49 per barrel. U.S. marker West Texas Intermediate dropped 7.9% to settle at $95.84. The euro teetered on the edge of hitting $1 for the first time since 2002 as the dollar attracted safe haven buyers as well as traders taking advantage of the gap between interest rate expectations in the U.S. compared with the Eurozone. The dollar index, which measures the greenback against 6 rival currencies and has a heavy euro weighting, was slightly higher on the day, up 0.1%, having earlier in the day hit its highest level since 2002. Investors have been spooked by business and consumer surveys that indicate a looming U.S. slowdown, with the central bank poised to aggressively raise interest rates this year to battle soaring inflations. Central banks are tightening interest rates into a slowdown, which is why commodity prices have turned, said Trevor Greetham, head of a multi-asset at Royal Asset Management. In a recession, he added, you would expect to see commodity prices crashing down, and we are in the early stages of that. Fears over the health of the economy are even more acute in Europe, where governments are worried about Moscow cutting off gas supplies, exacerbating an energy shock and cost of living crisis. Foreign exchange markets are discounting a severe European recession into the euro-dollar trade. Greg Anderson and Stephen Gallo of BMO Capital Markets wrote in a note to clients. This scenario has close links with energy supply constraints, they said, as well as winter or even summer fuel rationing. So you're going to get rationing. So that's what's going to happen in Europe. They're going to be rationing fuel because they don't have any other option if Russia is not going to trade with them as a response to the sanctions. I mean, Russia can't really, but also Russia is saying, we're not going to just help you out when you're actually waging active economic warfare against us. On the other hand, the rising interest rates in the United States are meant to slow down production and really slow down consumption. That's how they're getting prices down, by actually hitting the demand side so that the supply side can rebound. And I mean, this is the criminality of capitalism, is that you have the state mediating, not in the interest of people, because higher interest rates doesn't mean people are happy. It just means that consumer prices will go down because corporations are like, oh, okay, all right, we can handle this now. We can handle this. We're going to get more money on the dollar. Our investments, the bankers, they're going to get more money on the dollar. That's what is kind of making, it's kind of breeding more confidence, right, into these parasites. That's the criminality of capitalism. It's all about building the confidence of parasites. And so that's what's happening when it comes to these interest rates. And it would plunge the economy into a recession if they go on too long, because, well, it's interesting. You want to bring down consumer prices for the long term, but in the short term, what you're saying to people is, you're not going to be able to invest. You're not going to be able to make the economy viable, which means if the economy is not moving in an investment sense, which in the United States, it's questionable if it ever does. There's not much investment beyond financial markets in the United States. But nonetheless, that kind of slowdown would mean that these corporations would say, okay, no investment. Okay, we're slowing investment. That means we're going to cut jobs. That means we're going to plunge workers into the recession. Job cuts, closures of production, etc. That's what recessions are, quote unquote. That's an economic crisis. So futures linked to TTF, the European wholesale gas price, were 7.6% higher at 175.5 euros per megawatt hour, more than double their level of early June. Analysts expect that the Federal Reserve to raise interest rates by as much as 0.75 percentage points at its July meeting, from a current range of 1.5% to 1.75%. Future markets point to a benchmark U.S. interest rate of 3.4% for early 2023. By comparison, futures tip the European Central Bank to tighten monetary policy more slowly, nudging its deposit rate from minus 0.5% to just 1% over the next month. The yield on Germany's 10-year bond, a barometer for debt costs in the Eurozone, fell 0.11 percentage points to 1.13% as economic uncertainty drove demand for the low-risk asset. Bond yield prices fall as prices rise. U.S. government bond yields also fell, continuing to trade in a so-called inverted yield curve pattern that has historically predicted recessions. So the recession is coming. That's what they're telling us. We don't have to go into all this. This is all financial games. This is all just playing with your money, right? They're just playing with your money here. And the recession is coming, and they're preparing for it. They're boosting the interest rate. They're slowing down the investment. And eventually that's going to mean layoffs. That's going to mean closures. That's going to mean trouble for the working class. I mean, it already means trouble for the working class because the working class is already in trouble. People are struggling. The inflation has done its damage. And this whole boom of so-called jobs has not been what Biden and the rest tell you it's been. They always say, oh, we've created all these jobs. And we know under Obama that 99% of those were low-wage jobs. Same goes for today. There are no high paying jobs coming down the bend because there really is no investment. It's stagnant. And now they're going to roll it into the opposite, the other side of stagnation, which is contraction.